Right, good day learners. In today's lesson I'm going to look at the recording to do with wages and salaries. Now in class you will draw up Excel sheets, or it's like a whole lot of a spreadsheet in which you do the calculations associated with wages and salaries. Remember the difference between the two. Wages are generally paid weekly and are often paid in cash, although in today's day and age it's becoming less and less common. Salaries are paid monthly and generally will be paid directly into people's bank account. Wage people normally get paid so much per hour, and salaries are a fixed amount per month. Now there's certain concepts that are going to come in, and that's what you need to understand the difference. So the first thing is what we call our gross or our basic wage, and that is the rate or the wage or salary that you are employed at. So let's take, for example, and let's just work with salaries now because the principles are exactly the same. And let's say that you are going to work for an amount of 10,000 Rand per month. Now that would be your gross or your basic wage. But under the regulations in the country, you don't get paid the full 10,000 because there are certain deductions, certain costs that have to be taken off your salary. And under the regulations in the country, it's up to the individual business to deduct these amounts, to take it away from you, the worker, before you get it. So for example, let's look and say, right, maybe 2,000 Rand has got to be going to pay your taxes. We call that your PAYE, your pay as you earn. So as you're earning your salary, a certain percentage is taken away, and let's say 2,000 Rand has to go. Now that money is owed to SARS. Then, in most business houses, if you're a permanent employer, you have to contribute to the pension fund. This is so that the day that you retire one day, you can earn a pension. Now again, this is dependent on a fixed percentage generally of your salary, but let's for ease now, I'm not going to do calculations. Let's say it's 1,000 Rand you're paying in. Now that pension money will go to the pension fund. So again, the company will deduct it off your salary and the firm will pay it over to the pension fund. Then medical aid, to cover unforeseen medical expenses or general everyday medical expenses, and this is normally determined on how big your family is or how many people are on the medical aid. But let's say in our case over here for this worker, 800 Rand is taken from his salary, and that will be paid to the medical aid fund. And then it's compulsory in the country to pay towards the UIF, the Unemployment Insurance Fund. So if you are unemployed one day, you can draw UIF. At this stage you might still be employed, but you're contributing, you're paying into the UIF fund. And that is 1% of your salary, so 100 Rand is going to go off. So the firm is going to take these amounts here, these respective amounts here, this 3,900 that is here, 2,000, 1,000, 800 and 100. They're going to deduct that off the worker's salary and pay it over to the respective funds. The balance that's left over, now this over here, as I said there, comes to 3,900. Your salary is 10,000, so they're going to say, right, well, of the 10,000, we have now allocated 3,900, and that leaves us with an amount of 6,100. And that 6,100 will go to you, the worker. That is your net wage. Net is after deductions, like the net profit after all your expenses. And we put that to an account called creditors for wages or for salaries. Creditors, the worker is a liability. You owe him for his wage and salary. Now the important concepts in need that you need to work out here is the cost to the company is 10,000. That's what they've employed you at. That's what they have to pay out. That 10,000 is going to be paid to various different people. Some to SARS, the pension, the medical aid fund, the UIF, and whatever's left over will go to you, the worker. Right, now the first part would be to do the calculations, and you do that in your wages or salaries journal. The challenge though is that this and these figures have then got to be posted into the ledger. So our double entry is that 10,000, the gross, is our total cost. So that 10,000 is going to go into your expense account, which is your wages and salaries. Now that's an expense account. So using your DAX cell, it will be a plus minus account. Now that 10,000 is going to be paid to different people. Now today, we were just doing the calculations. We were not doing the payments. So we are incurring a whole lot of liabilities. We owe SARS 2,000. Remember, that was these figures that I had over here. So I'm going to take these figures here now and I'm going to record them. I owed 2,000 Rand to SARS. SARS becomes a liability, so it's on the credit side. I owe the pension fund 1,000. I owe the medical aid 800. I owe the UIF 100. And finally, I owe the creditors for salary, the workers, 6,100. Now what is important here? These five credits over here, if you add these amounts up, they will equal the 10,000. So this 10,000 is your debit entry. That is your cost. And you split it up and you put out to who you owe the money to. So when you come to double entry here, you're going to have, and I am abbreviating now because I wanted this on one page, it'll go wages and salaries. This is all part of the wages and salaries, and your folio will be the salaries journal in this case, with the respective dates. So there's all your credits. All of these credits here are a double entry into the wages and salaries, and so because it went to 5 different accounts, we can say sundry accounts. You use that concept when you post it to the cash receipts and cash payments because it was made up of a whole lot of different entries. The 10,000 is split across the different liabilities that you owe the money to. Now, it seems simple enough here to look at this, but grade 10s, when you move into financial statements, you often get asked to do an adjustment for this, whereas a person's salary has been left out and you're not doing the ledger, but you've got to know that your expense is increasing, but so is all the liability accounts. So now we've looked at the deductions. The deductions is what comes out of the actual worker's salary. So his salary is 10,000 and coming out of his money, so actually he's paying it. Although the firm takes the money away from him and pays it for him, it's coming out of his money. So deductions is what the worker has to pay. But it's common practice in most businesses for the firms then also to contribute. They have contributions where they pay extra into the respective funds. So in this case, the firm might pay an extra 2,500 into the pension fund. They might pay 1,600 to the medical aid, and again, by law, they have to pay 1% to the UIF, so another 100 Rand. So there are more costs to the company. So how do we bring that into the books? And so there was an extra 2,500 we said to the contribution. So this is the pension fund contribution. So there's another cost to the company, another 2,500. So it's an extra. Over and above the 10,000, there's another 2,500. That pension fund contribution is then also owed to the pension fund. So there's the double entry, which I've got in blue. There's the expense. What are we paying? And who are we paying? So over here, we're going to have pension fund contribution. And again, please, I am abbreviating, but you've got to refrain from this if you can. And pension fund. The company then pays another 1,600 Rand to the medical aid. So it's another cost, another expense, another debit. And that is owed to the medical aid. So medical aid contribution and medical aid here. And then 100 Rand to the UIF. So into the UIF fund, but this is the UIF contribution. So the contribution is what the company pays into the funds. The deduction is what the worker pays. Now if we have a look at this, the total cost to the company to employ this worker is not just the 10,000. Although he doesn't get it in his pocket, the company is paying, because they employ him, an extra amount to the pension, the medical, and the UIF. In other words, the cost of employing this person is actually 14,200. The 10,000 for his original wage plus the contributions. So the cost to employ this person is 14,200. That 14,200 is broken up into various different liabilities. So for example, if you look at the pension fund, you actually owe the pension fund 3,500. 1,000 coming from off the worker, and 2,500 coming off the as the contribution. And so these liabilities now are in the books. And if you add all this up, it would equal up to the amount of the wages and salaries. The actual costs here plus the contributions. If you were drawing up a balance sheet at this stage now, these amounts, the debits, would all appear in your income statement. They're all costs, they're expenses to you. These are all liabilities, and these will all appear under your current liabilities, all debts you owe. Eventually, these liabilities will be paid, so you will credit your bank, and you will then debit each of these accounts, and you'll have bank, and you'll pay the taxman 2,000, and that will be settled his account. So when you pay, you don't pay unless they tell you to pay. It'll be a cash payments entry, credit bank, and you will debit the respective liabilities that you pay. Right, learners, as I said, the calculations themselves are not really that difficult, but actually managing them as an adjustment, which will come later, is going to require insight. So it's very important that you're understanding what you're doing. You're not just doing this like a parrot, that you understand why you're debiting, and that there is a corresponding double entry in the credit and where it is. Right, good luck.